From some questions I'm getting and quiz results, it still appears Chapter 3 is a challenge, and I suspect free cash flow is the main problem. So I want to walk through the free cash flow example from Chapter 3 for Allied Foods in detail as to where the numbers come from and why. These numbers are taken directly from the Allied Foods example in Chapter 3. In the examples we'll look at, the light blue cells are the numbers we're going to use to find free cash flow. So here's Allied's balance sheet numbers from 2015 and 2016. From these we need total current assets for both years for net operating working capital, net plant and equipment for both years for capital expenditures, notes payable for both years for net operating working capital, and total current liabilities for both years, again for net operating working capital. Moving to the income statement, we need depreciation and amortization for 2016 only, and EBIT for 2016 only, and the tax rate. Scrolling down further, the statement of cash flows. We can use data from the statement of cash flows as an alternative source for fixed asset investment data, specifically the additions to property, plant, and equipment for 2016. Now let's walk through the free cash flow calculation step by step. The result is shown. Free cash flow is a negative $109.70 million. We need EBIT from the income statement, $284 million, the tax rate from the income statement, 40%. Using these, we can find EBIT times 1 minus the tax rate, after-tax operating income, $170.28, and depreciation and amortization from the income statement, $100. To find capital expenditures, we have two options. From the balance sheet, net plant and equipment for 2015, $870. Net plant and equipment for 2016, $1,000. Depreciation for 2016, $100. So capital expenditures is net fixed assets for 2016 minus net fixed assets for 2015 plus depreciation, $230 million. Alternately, we can find the same number from the statement of cash flows. It'll be shown as the investment in plant and equipment, and it'll be negative because it's an outflow, $230 million. Before we finish free cash flow, I want to walk through how the balance sheet numbers and the statement of cash flow numbers fit together. The numbers in the gray cells on the right, I made them up to show how this works and to make the numbers work out. So let's assume at the end of 2015, Allied had $1,500 in gross fixed assets, $630 in accumulated depreciation, resulting in net fixed assets of $870, the balance sheet number. During 2016, Allied invested $230 million in plant and equipment from the statement of cash flows. They also added $100 to depreciation from the income statement. So at end of year 2016, gross fixed assets is the $1,500 plus $230, $1,730. Accumulated depreciation is the $630 plus $100, $730. So net fixed assets for 2016, $1,730 minus $730, or $1,000. Again, the balance sheet number. Here's the bottom line. If you use net fixed asset numbers from the balance sheet, then you must add depreciation back to find the total investment in plant and equipment. Net means depreciation has been netted out. It has to be added back. If you use the statement of cash flow number, you do not add depreciation back. The statement of cash flow number can be described as the firm added so many dollars to fixed assets. Remember, we're concerned with cash, so if depreciation has been taken out, it has to be added back since it's a non-cash expense. Finally, the change in net operating working capital. From the balance sheet for each year, current assets, current liabilities, and notes payable, so that net operating working capital is current assets minus the quantity, current liabilities minus notes payable. We find both of those numbers for 2015, $650, for 2016, $800, so the change is the difference, $150. Ultimately, given all the components calculated, we can easily find free cash flow. I hope this will clarify how the elements in the balance sheet, income statement, statement of cash flows, and the free cash flow computations work together, specifically how depreciation fits in, when it's added back, and when it isn't.